Hey guys, thanks for checking out this week's FinPrep Trading and Investment video newsletter. So in terms of the SPY, what we have is still floating atop the trend line going back to the 420 year-to-date highs in through 2016 up until this basically breakout to new all-time highs, which occurred in July of this year. And basically that is acting as a trend line kind of capping price rallies, as you can see over the past week or so. So S&P still hanging in there, floating up on low volume. Nothing terribly exciting, not a lot of volatility, and yet we're about 2.2% above prior all-time highs from May of 2015. So is it technically a breakout or not? It remains to be seen. Again, keeping in mind the general rule of thumb of a breakout being, 3 if you want to be extremely conservative, 5% above prior all-time highs. So not discouraging price action, but at the same time, it has to prove itself. So that's what's going on with this S&P. So what else we're going to look at this week in lieu of material, given what the non-action and the trading of the equity, is basically a relative price performance chart. And so the point here, and just to kind of ground you, right, is this is the S&P year-to-date performance. So all these lines represent essentially price changes, percentage changes over time. So what we have is the S&P being up 7%. And the thing that's interesting is, even though this is considered generally a good year for stocks, it's interesting that TLT, so representing the long end of the Treasury yield curve, so government bonds basically, are outperforming the S&P by a factor of about 2.25. So you're getting better bang for your buck in Treasuries than you are in the stock market. Another way to put it. And above and beyond that is this is kind of a shining year, a standout year for the metals. So gold is up about 25%. So using the general rule of thumb, just from a numeric basis of a bull market being 20% price increase from lows, and then the opposite for a bear market. So basically, you could say that gold is within a new bull market as just determined by price change. So being 25% above its prior low, or at least on a year-to-date basis here, is significant. So is gold in a bull market is the question. Is silver in a bull market? So again, even silver up 42%, basically the best performing primary asset class there is so far year to date. That can of course change, but pretty impressive showing from the metals so far, especially this deep into the year. Generally we can see this type of stuff, at least in the past few years, in the first few months, and then fade off, but such isn't the case this year in 2016. The other point I wanted to make, so in keeping with that piece, so this is the underlying metals, and then the guys up here are the ETFs representing a large basket of the stocks, the miners in particular, and generally affiliated equities within these markets. So if we're looking at GDX is up basically 5 times, outperforming the metal. So that could be kind of a sign of exuberance, and I think that's being generous. So on a daily basis, you could tend to see if gold is changing by price, by 1%, you'll see the miners essentially changing by maybe 2.5. So to see on a year-to-date basis that it's 5 times above the price change in the metal is very interesting. And then similarly with the juniors, so a bit smaller companies, more risk, you would think it's outperforming the underlying metal significantly by about 6.5 times, so 650% more price appreciation than the metal. So at least as a contrarian, that should bring a bit of caution. It's been great if you're riding it on the pro-cyclical basis, but if you're looking out for a longer-term placement of deploying significant capital, you may say, I may want to pause here. Or if you're long already, obviously this is a place where you start to consider to take some chips off the table. It's just general good practice. And then in terms of silver, the silver miners, one I haven't actually looked at too much, but so I can't speak to the percentage change on a daily basis and how does that compare relative to the metal, but it just does seem quite impressive, if not excessive, of about 4.5 times in these two ETFs, SIL, BP. Again, I haven't really watched them on a daily basis, but that is about 4.5 times more than the metal, which again does just on the face of it seem a bit much. So obviously it would be great to be a partaker in the rally, though the sense is, at least for our personal basis, perhaps not yet, given how stretched that is. So that's the relative price performance. The other factor to consider then is the seasonality. So this is the seasonality chart. This is from stockcharts.com. And basically the right-hand axis, I won't rely on it as much, but it's basically the percent of up months, just to make it quick. So the higher the bars, the greater the post-hoc probability of up months for any given month, as laid across the other axis here. The other piece I want to focus on is the little figures within the bars, and these are the monthly average price change. So basically, quickly recapping is, you tend to get a nice beginning of year rally out of GLD, at least since 2004 to 2016 on average. August tends to be a strong month, which is the month we're currently in, though that's kind of tempered by a bit weakness in the fall, and then December being actually a slightly negative month. So knowing that, or having that as a backdrop, knowing the seasonality of gold, as it were, that doesn't necessarily mean that this determines what will happen every year, but it is good to know if you want to view it from a perspective of what are the historical odds of a rally continuing into the next few months. You would look at this, and perhaps, again, depending on your approach to the markets, we obviously want to look at what is the risk of drawdown, so risk reward, right? So what is the expected gain versus the expected loss, and how do we minimize that by choosing not only at what price, but at what time do we enter to create that ratio to be as favorable as possible. So the best reward for the least amount of risk being, in this case, drawdown. All right, so that's basically just a very quick primer on some of the factors that we're looking at with regard to gold. We'll go over in a completely separate video the price history over the long term of gold, but needless to say, began the year with a bang, as we kind of saw already with that relative performance chart, and here we are hanging out. We are hanging out a bit below the 250-week moving average, and this primary downtrend, which extends through the peak in 2011 up through the run-up anticipation of QE3 in 2012. So this, again, from a risk-reward perspective, could it break out? Possibly over time. But this is not the place where at least we're personally interested in getting too involved on the long side. And then similarly with the gold miners, that's the hot sector this year, no doubt. I mean, it probably is the best performing primary sector within the equity markets in general. And that's not surprises. You can just see a complete rocket moonshot and then this primary price channel at a very steep angle. So given that we are hanging out, well, it's positive that we're above the 250-week moving average and currently able to hold it, but we are near the upper end of the price band. So anytime you're at the upper end of a price band, you have the risk of coming in, upper end of the price band, coming into the lower band, and of course the opposite applies to the lower band. If the trend holds, then that then becomes a place for a price to launch. So again, so patience would seem to be a virtue here, is kind of the sentiment or conclusion that we're drawing based on the data, at least for our own personal accounts. So that is what's going on, guys. I wanted to share those thoughts with you. Again, I'll go through the walkthrough of the history, give you a bit more context on what has happened with regard to the metals, but basically the outstanding question here is, has the bull market begun? So just simply from a price performance perspective, the way it's generally treated in the media is, oh, yep, gold and silver then would be in a bull market. But does that truly mean what we're interested in here at FinPrep is, are we really at an inflection point? Can we truly count, or at least would the odds seem to suggest that we are in a bull market and that a persistent move in a certain direction would occur? And so we'll kind of come to that conclusion over time, obviously, and also with regard to the data, the price, and we'll go over that in a different video. So thanks for checking this out, guys. I hope you find this useful, and glad to bring you new information that you probably don't get to hear quite often. So with that, have a great week. I'll talk to you guys later. See you.